So, if you take a step back and look at history, one pattern shows up over and over again. During the final stages of an empire, there is almost always a struggle over power. Not just political power in the traditional sense, but control over money, trade, and ultimately the rules that govern the entire system. The real question becomes, who gets to decide how the game is played? Today, I want to walk you through a very relevant and modern example of this dynamic unfolding in real time. If you remember, back in 2025, the US president initiated a series of tariffs against several major trading partners. Specifically, there was a 25% tariff placed on imports from Canada, another 25% on goods coming from Mexico, and a 10% tariff applied to Chinese imports. At its core, a tariff is simply a tax imposed by a government on goods entering the country. Now, from the market's perspective, this was not well received. Investors reacted negatively, and the stock market showed clear signs of discomfort. The reason is fairly straightforward. U.S. corporations were the ones responsible for paying these tariffs. That meant higher costs, tighter margins, and potential disruptions across supply chains. However, from the government's point of view, there was a clear upside. These tariffs generated billions of dollars in revenue. On paper, that looks like a significant financial gain for the state. But the story doesn't end there. More recently, the Supreme Court ruled that the president does not have the authority to impose such tariffs under emergency powers. This decision effectively invalidated a large portion of the policy. As a result, the revenue that had already been collected may now need to be returned to the companies that originally paid it. The ruling came down in a 6-3 decision, representing a major setback for the administration's economic agenda. That's the first layer of the story. Now let's move to the second layer, which is arguably far more interesting. While this legal battle was playing out in the background, reports emerged suggesting that a financial entity had been actively buying up claims to potential tariff refunds. These claims were reportedly purchased at a steep discount, roughly 20 to 30 cents on the dollar. To put that into perspective, imagine a company paid $100 in tariffs. Another party could step in and purchase the rights to a possible refund for just $20 to $30. If the tariffs remained in place, that claim would be worthless. But if the court ruled against the tariffs and refunds were issued, that same claim could be worth the full $100. That translates into a potential return of 3x to 5x, depending on how the situation resolves. Now, according to some reports, one of the firms involved in this strategy was Cantor Fitzgerald, a major financial institution with close ties to Commerce Secretary Howard Lutnick. This is where things start to get complicated, because now you're looking at a situation where individuals connected to shaping economic policy may also be indirectly positioned to benefit financially from the outcome of that policy. Even if all legal requirements are technically met, the optics alone raise serious questions. Some people would label this as crony capitalism. The firm in question, of course, denies any wrongdoing. But whether or not the specific allegations are true is almost beside the point. Because the real takeaway is much bigger. This isn't just a story about tariffs. It's a window into how different forms of power interact and how financial systems operate alongside political systems. To understand this properly, we need to step away from the idea that there are clear good guys and bad guys. That framework is too simplistic. Power doesn't operate on morality, it operates on incentives. Different groups have different goals. Sometimes those goals align, and sometimes they directly conflict. And often, the same individuals or institutions can exist in multiple systems at once, representing overlapping interests. At its core, this is a system where various players compete for influence, control, and revenue. And the primary tool they use to achieve that is leverage. There are many different types of leverage. Political leverage, for example, comes from the ability to influence voters, shape public opinion, and win elections. Financial leverage comes from controlling the flow of money. If banks tighten lending, businesses struggle to expand. If investors sell government bonds, interest rates rise. That alone can ripple through the entire economy. There's also military leverage. Simply having the capability to project force or control strategic routes, like shipping lanes or energy corridors, creates influence, even without direct conflict. And then there's technological leverage. Control over semiconductors, artificial intelligence, digital payment systems, and data infrastructure can be just as powerful as traditional forms of control. During stable periods, these forces tend to operate quietly in the background. Most people don't notice them. But during periods of transition, like the one we appear to be entering now, these dynamics become much more visible. So who are the main players in this system? First, you have the sovereigns, governments, political leaders, and state institutions. Their goal is to maintain or expand national power, especially in a world that is becoming increasingly multipolar. Second, you have the financial industrial complex, Wall Street, hedge funds, banks, and global capital allocators. These entities operate across borders. Their primary focus is not loyalty to any single nation, but rather the efficient movement and growth of capital. Third is the military-industrial complex. Defense contractors and related networks benefit from instability, conflict, and the ongoing demand for security. Fourth is the technological industrial complex. Large tech companies, AI developers, and digital infrastructure providers. Their leverage comes from controlling the systems that everyone else relies on. Now, within this framework, what is the United States actually trying to do? At a high level, it is attempting something extremely difficult, transitioning its economy away from financialization and back toward industrial production. In other words, shifting from an economy driven by financial assets and services to one that produces tangible goods. Tariffs are one of the tools being used to support that transition. From the sovereign perspective, tariffs can protect domestic industries and encourage local production. But from the perspective of financial markets, tariffs introduce uncertainty, and uncertainty creates volatility. And volatility, for those who understand it, creates opportunity. That brings us back to the earlier example. Even in situations where no laws are broken, those with access to better information or closer proximity to decision-making processes often have an advantage. They can position themselves ahead of major outcomes. This is sometimes referred to as the Cantillon effect, where those closest to the source of money or power benefit first and most. But stepping back even further, the bigger issue is structural. For decades, the U.S. operated under a model where it exported dollars, outsourced manufacturing, and expanded its financial system. This approach strengthened Wall Street and drove asset prices higher, but it also weakened domestic industry and hollowed out parts of the middle class. Now, that model is being challenged. Countries like China have taken a different approach, using trade surpluses to build infrastructure, strengthen industrial capacity, and expand geopolitical influence. As a result, the global balance of power is shifting. Historically, when nations face rising debt levels and trade imbalances, they tend to have three main options. The first is austerity, reducing government spending or increasing taxes. Politically, this is extremely unpopular. The second is fiscal dominance, allowing inflation to run somewhat higher while keeping interest rates relatively controlled, gradually reducing the real burden of debt over time. The third is currency devaluation, weakening the national currency to improve export competitiveness and ease debt pressures. Tariffs can be seen as part of this broader strategy, a way to rebalance trade without directly addressing the currency itself. But this creates a fundamental tension. It is very difficult for a country to maintain a strong global reserve currency while also being a competitive manufacturing powerhouse. These two goals often work against each other. And within the country itself, different groups have different incentives. Even within government institutions, there is no single unified objective. Policymakers represent districts, industries, donors, and various constituencies. Their interests don't always align perfectly with broader national goals. This is why policies like tariffs can become so contentious. In the end, whether tariffs remain in place or are removed is only part of the story. The deeper reality is that we are witnessing a complex interaction between different forms of power: sovereign, financial, military, and technological. And in that system, those who understand the incentives and can anticipate how events are likely to unfold, are often the ones who position themselves to benefit the most. That's how power actually works.